Welcome back then YouTube. Today I'm taking a look at a UK stock which in my opinion currently represents one of the biggest buying opportunities out there. Now don't get me wrong, this market is a mess right now, and in my personal opinion that's probably going to get worse before it gets any better. However, I do believe that this stock is now too cheap to ignore, so I have been a buyer recently. Now, before we get into it, if you could like the video for me, that's going to help to beat the infamous YouTube algorithm, and of course you can subscribe to the channel for more similar content. Now, the company that I've been buying is Boohoo, a UK AIM-listed fast fashion retailer. For anybody that doesn't know, you're going to find them under ticker symbol BOO. They sell clothing and other fast fashion items via a number of different in-house brands, primarily to millennials and to Gen Z. Very big on social media, but they do occasionally make headlines for the wrong reasons. Most notably was probably in 2020 when a factory in Leicester that formed part of their supply chain was paying employees less than the minimum wage and providing pretty horrible working conditions. Now, I actually took a look at Boohoo around that time, but I decided to give it a hard pass. They did actually deal with that situation pretty well though. They met it head on, and I believe they ended up publishing a list of all the suppliers within their supply chain, and it now makes up part of their corporate governance report, or certainly as a minimum it gets mentioned on their webpage. Following that incident, the share price did recover somewhat, but not long after it started to fall, and it hasn't really stopped since then. Look at the 1 year chart here. The company has lost around 3/4 of its value over that 1 year period. Current share price is 88 pence, although it's been as low as 85 pence this morning, which I cannot believe. This is a genuine penny stock. Now, Boohoo has become a penny stock. Of course, I don't want to fall into a value trap here. There are plenty of companies out there that are down 50, 60, 70% on the 1 year. So let's go and take a look at some of the numbers behind the company. Okay, this page here is London South East. They present their information in a pretty digestible format. So we're going to take a look at this one together because I want to go through some of the numbers behind this company. So you can see here, current share price this morning is bouncing around a little bit, but somewhere around that 88, 89 pence per share mark. Not far off the 52-week lows, actually, which we'll have a look at in a second. The current year end is ending in, or the current period is ending in a week's time, so 28th of February 2022. So we should be getting some new information on this one. You can also see here, if I highlight this in the corner for you, market cap 1.12 billion. Now, I don't think this market cap is going to squeeze below the £1 billion mark, but even 1.1 billion, that's very, very low for Boohoo. Price to earnings ratio. So I just want to point this out because they've got a price to earnings ratio here of 11.89. So that is going to be based on the last full year of accounting information. So the 28th of February 2021, that figure is going to be based on. So we'll come back to that one in a second. We'll make that more relevant for the current period because there's no use going off historic data. Probably better actually going off your forward P, to be honest. But we'll come back to that one in just a second. The 52-week low I mentioned a second ago is 82. So it was 85 previously, but we've just hit 82 this morning, and that's going to be based off of all this tension in Russia, or Russia sending in troops to Ukraine already. So we've touched those 52-week lows already this morning. And then we've got some financial data. So again, the financial data is a little bit out of date. It's historic, but I will point out a couple of things here. So look at the top line. Look at the revenue figures on here. 294, 579, 856, 1234, 1745. And what do you think the current year is going to be? Around the 2 billion mark? Yes, most likely. And in fact, they will they'll mention that in a minute in their trading update. What you can see is top line growth every year. It's exactly what you want to see from a growth company. As well as that, a little bit further down the page, you can also see either of these, the post-tax profit or the profit for the period, 24, 36, 47, 72, 93. Exactly what you want to see from a growth company. Not only growth on the top line, but growth on the bottom line as well. And they're achieving pretty significant earnings already for a fairly small company. Below that on the page, we then have a little bit more financial information. So we've got the balance sheet. I'm not going to go into great detail on the balance sheet because, again, we're looking backwards here and we're a year out of date. The key figures I would probably point out here are cash at bank. So you can see here in the most recent set of accounts, 276 million cash at bank. Again, they made acquisitions and a lot of capital spend, so some of that may be eaten away at. But again, the trend that you will notice here, if you look at net assets, which is assets less liabilities, well, look what you can see. 100 million, 200 million, 270, 327, 472, growing every year. This is why I think Boohoo is your perfect growth story. The only other useful information that I thought was pretty relevant from this page, down here at the bottom, you can see this, the PE ratio. So this is based on the share price at the time the financial accounts were issued, and again, obviously looking backwards year on year. So same situation though. What you can see is kind of what you would expect for a growth company. This time the other way round. You expect over time that as a growth company seizes their potential, as they grow and they take market share, you expect the valuation to get squeezed, the price to earnings ratio to get squeezed, and that's what's happening. 68 down to 56, down to 41, a slight bump to 48 and down to 37. If you take the trend there, so we're trending downwards, typically, over that 5-year period, we're dropping about 10, 11% per year. So if you apply that to 2022, the current period, you would expect the price to earnings ratio to be around 33 or so. Now, I accept the fact that we've moved into a different environment now. We're now in a inflationary environment with raising rates, which are likely to impact these growth companies. So the valuations get squeezed away from that. So the long-term trend says an appropriate price to earnings ratio for the current period would be 33. Take into the fact that we are in a rising rate environment, which is a lot worse for these growth companies. I would say, because this company is earning money already, if you invest money in Boohoo, you're going to get a return on your money tomorrow because the company is earning, it's making a net profit every single year. I would say that that would leave it in a better position than companies who say have no earnings, or some that even have no turnover at the moment. So you expect that price to earnings ratio maybe to get squeezed down to 30, maybe high 20s. But to get a better picture of what the current price to earnings ratio really is, we're just going to switch across and have a quick look at the trading update that they gave. Now, this is the trading update here that Boohoo gave for the period ending November 2021. Again, we're probably expecting another one of these following the year end shortly. But in this trading update, you're going to see the reason why we've seen so much downward pressure, because of a lot of the guidance that they gave and the update that they gave here. What you can see, though, let me zoom in a little bit for you, is a general overview is top line is still growing, 10% up over the period. The UK performing exceptionally well, 32% up for that segment, or that geographical segment in the period. And then all other segments down, 12% down, 14% down, 21% down. I'm not sure if you can see here, but that's for the rest of the world, the rest of Europe, the United States, and countries outside of that as well, which make up a smaller proportion of their sales. This is exactly what you would expect for the current trading environment, where we've got a lot of pressure on supply chains. What do you expect? A company that is based in the UK, who do you expect to be impacted? All their customers outside the UK, because you can't get the products to them. It's longer lead times. It's taking longer to get deliveries there. It's costing more to get deliveries there. As well as that, if Boohoo have to make decisions about which customers they send products to, maybe because that's a limiting factor for them, then obviously they're going to choose the customers in the UK because it's a bigger margin. They haven't got to incur all that freight and shipping costs. So this is exactly what you would expect to see in the current environment. But again, still growing 10% on that top line figure. The other useful information that you'll find here is on the second page, their guidance and outlook. So we can read in here, for the year ending 20th of February 2022, the period that's just about to end, we're now expecting growth to be between 12 and 14% compared to what was previously guided at 20 to 25%. So a huge downturn there, absolutely huge, and that's why we're seeing this downward pressure. This reflects our expectation that the factors impacting our performance in the period persist through the remainder of the financial year. Okay, and they talk about Omicron. They also mention, as well as that squeeze to top line growth, they're also mentioning that adjusted Ebitda margin for the year is expected be between 6 and 7%, previously guided at 9 to 9.5%. So we're getting squeezed on the top line. We're not growing as quickly as we thought we were. The revenue we are generating, it's costing us more to generate, so we're getting squeezed on that Ebitda margin as well. And it does go on to say that, although before I mention this, midterm goal for Boohoo is to get that Ebitda margin back to 10%. Even with this dip here, they're still expecting in the midterm back to 10%. So probably not this year or the following year, but we're looking at 2-3 years out for that. They give an Ebitda figure which isn't hugely helpful, of somewhere between 117 million and 139 million for the full year ending 28th of February 2022. Now, I don't know about you, but I never tend to use EBITDA for valuing a company. I much prefer to use a net profit figure. That's what ends up in our pockets as shareholders. And that's what gets carried forward. So to get an idea of what 117 to 139 million of EBITDA looks like as a net profit figure, it's probably easiest if we go and take a look at the guidance from analysts, which isn't really too hard to find. It's linked on the Boohoo Investor Relations page. You'll see the consensus figures for all the analysts that are covering this particular stock, which is very helpful. And what you can see here, the adjusted profit before tax. So they're still not giving you the net profit figure, but they are giving you a profit before tax figure. The average between the analysts, they're estimating around 79.5 million of profit before tax. Again, not hugely useful in terms of evaluation, but if you take 80 million or so and you apply 20% tax to that, now that's not exact. You don't apply tax to that figure there. It's a lot more complicated than that. But just to give yourself an idea, if you take 80 million and take 20% tax off, you're left with 64 million. 64 million of post-tax profit on this current financial year. If you take a 1.1 billion market cap and divide that by 64 million, that gives you a current PE of 17.18. And that there is my reason for buying Boohoo. The current PE is around 17. The long-term trend, without factoring in the current market conditions and the rising rate environment, tells you that the long-term trend for the PE should be around 33. Remember, dropping it by about 10-11% per year. Should this current rising rate environment that we're in be cutting that price to earnings ratio in half, all the way down to 17 as we see it today, or possibly below 17 as we hit that 52-week low? No, I do not believe so. I believe this is a short-term blip. I believe the market is overreacting, and that is why I'm putting money into Boohoo. So those are the numbers that I'm interested in. This is a perfect growth story, in my opinion. Growth on the top line, growth on the bottom line, up until the current year. Not only that, but the company generates pretty significant earnings already, meaning an environment where inflation is prevalent and interest rates are rising, like we're in right now, shouldn't be as hostile for it compared to some of those loss-making companies. Of course, based on that guidance from Boohoo, it looks like the year to February 2022 is going to be a big step backwards, certainly for earnings anyway, but the top line is still growing. Revenue is still likely to be up 10% on the prior year. So I'm making a bet that this period to the end of February 2022 in a week's time is the period that bears the worst trading environment for Boohoo. And as we move beyond that, all of the headwinds that they are now facing will start to fade away somewhat. They won't disappear, but they will ease off. The Bank of England is predicting inflation to peak in April, which, if that is the case, should help to give a bit more certainty over interest rate hikes. COVID isolation in the UK for positive cases is set to end this week, which is going to help with staffing issues caused by compulsory isolation. Countries like Australia, New Zealand, and many others around the world are easing travel restrictions, which will help with shipping to international markets as lots of freight actually gets sent on passenger flights. Overall, I think that as 2022 progresses, Boohoo will move closer and closer to a normalized trading environment. And these results that we're about to see will be a big one-off. The one problem that may take longer or will take longer to change is this risk-off environment that we find ourselves in right now, which is exactly what's been squeezing the multiple right down to 17 on Boohoo and could potentially squeeze it even further. What I would say is I'm a buyer at a multiple of 17. My personal price target to start buying Boohoo was £1 a share, and we're more than 10% below that now. So I continue to buy and build my position. Let Boohoo keep growing the top line like they've always done. As supply chains then ease, the bottom line will follow. And when markets eventually go risk on, which they always do, they always go risk on at some point, Boohoo will absolutely fly. Of course, that is only my humble opinion, but I'm always interested to know what you're all buying right now. Let me know what you see as the biggest buying opportunity right now. That is all for today. Thank you as always for watching, and I'll see you next time.